Hi everyone, my name is Jihan Hardiyanti Arief, and today I will present my equity valuation analysis of PT Perusahaan Gas Negara or PEGAS, a listed company on the Indonesia Stock Exchange. This presentation is prepared as the part of the Financial Management and Policy Meet exam course at SBM ITB Jakarta. In this presentation, I will evaluate whether PEGAS has successfully created a shareholder value and whether the company's stock is undervalued, fairly valued, or overvalued based on the financial analysis and valuation methods. So this is my structure of my presentation that I will brief explain the company overview and industry landscape at first, and then I will talk about the financial performance and key financial ratios over the past 5 years. I will present also the financial forecast, WACC calculation, and discounted cash flow or DCF valuation. Then I will show the sensitivity analysis and relative valuation compared to the peers or the indirectly competitor, and also I will give the investment recommendation and strategic considerations. So, Perusahaan Gas Negara or PEGAS is state-owned enterprise that operates in natural gas transmission, distribution, and trading in Indonesia. The company was founded in 1965 and has been listed on the Indonesia Stock Exchange since 2003. In 2018, Pertamina increased its ownership in PEGAS, making PEGAS the gas subholding within the Pertamina Group. This consolidation strengthened PEGAS' role as the backbone of Indonesia national gas infrastructure. In terms of operational scale, PEGAS managed more than 13,500 kilometers of gas pipelines across Indonesia and serves more than 830,000 customers, including households, industrial users, and also the small businesses. The company business segments include gas trading and transmission, exploration and production through Sakai Energy, and other gas-related operations such as LNG and CNG. With this infrastructure and network, PEGAS plays a critical role in supporting Indonesia's energy distribution and industrial development. The natural gas industry plays a strategic role in the national energy system. The gas value chain consists of the three main stages: upstream exploration and production, midstream transmission, and downstream distribution to end users. PEGAS operates across this entire value chain, but its strongest position is in the midstream and downstream segment, where it controls of majority of gas pipeline infrastructure in Indonesia. Currently, PEGAS control more than 95% of Indonesia's natural gas distribution infrastructure. This dominant position became even stronger after Pertamina Gas or PETAGAS was consolidated into PEGAS in 2018, effectively eliminating direct competitors in the listed market. However, the company still faces several risks. First, declining upstream production from aging gas fields may limit future supply. Second, there is foreign exchange exposure since many revenues are in USD while some costs are Indonesia rupiah. Third, long-term demand may gradually shift as renewable energy grows after 2040. On the positive side, there are strong macroeconomic tailwinds. The Indonesia government position natural gas as a transition of full toward net zero emission by 2060. According to PLN projections, gas demand for electricity generation is expected to grow by around 5.3% annually until 2034. This demand growth supports PEGAS' long-term market position. Now, let us talk or look at the company financial performance over the past 5 years from 2020 to 2024 based on the annual report that I can reach. Overall, PEGAS demonstrate consistent financial growth. Revenue increased up from approximately 539 million USD in 2020 to 843 million USD in 2024, representing an increase about 56.5% over 5 years. At the same time, net income more than doubled, rising from 106 million USD in 2020 to 224 million USD in 2024, which represents about 110% growth. Looking to the balance sheet, the company also maintains a stable financial structure. Total assets increased steadily while total liabilities gradually decline, indicating the stronger financial stability. In addition, cash and cash equivalents increased significantly, reaching more than 605 million USD in 2024. Overall, the financial data indicates that Pegas has achieved consistent operational growth while maintaining a solid balance sheet position. Next, look at to the company's financial performance using I use the several key financial ratios. First, in terms of profitability, Pegas shows consistent improvement. Net profit margin increased from 19.78% in 2020 to 26.61% in 2024. Return on assets increased from 5.01% to 9.48%, while return on equity rise from 6.89% to 12.28% over the same period. This indicates that the company is becoming more efficient in generating profit from its assets and equity. Second, look at to the liquidity. The current ratio improved significantly about from 0.82 in 2020 to 1.50 in 2024, indicating stronger short-term financial stability. Third, to the debt-to-equity ratio declined gradually, suggesting that management has been reducing leverage and strengthening the capital structure. Finally, using the DuPont analysis, we can break down that drivers of the return on equity. The improvement in ROE is mainly driven by higher profit margins and improved assets efficiency rather than increased financial leverage. This suggests that the improvement in shareholders' returns come from stronger operational performance, which is a positive sign for long-term sustainability. After analyzing historical performance, the next step is to estimate the company's future cash flow, which will be used for the valuation model. In this analysis, I forecast the company's free cash flow for the next 5 years from 2025 to 2029. Several key assumptions are used in the forecast. First, revenue growth is assumed at 8% per year, which reflects the average growth rate from 2021 to 2024, adjusted to remove temporary spikes. Second, net profit margin is assumed at around 25%, which is consistent with the company historical performance. Third, capital expenditure is estimated about 8% of revenue, reflecting continued investment in pipeline and gas infrastructure. Finally, the terminal growth rate is set at 3%, which represents a conservative estimate aligned with the Indonesia long-term GDP growth. Based on this assumption, the company free cash flow is projected to grow steadily over the next 5 years. As shown in this chart, Pegas free cash flow is projected to increase from approximately 230 million USD in 2025 to around 312 million USD in 2029. This represents roughly about 8% compound annual growth. This growth is supported by several structured drivers. First, increasing domestic demand for natural gas, especially from power plants and industrial users. Second, continued expansion of gas transmission and distribution infrastructure. Third, improvement in operational efficiency and cost management. Overall, this trend indicates that Pegas is expected to maintain a stable and growing cash generation in the coming years, which is a key factor in the valuation process. To discount future cash flow, we need to calculate the company's weighted average cost of capital, or WACC. Based on the financial model, Pegas has a WACC of approximately 11.07%. The cost of equity is estimated at 11.23% using the capital asset pricing model with a risk-free rate of 6.5%, beta of 0.86, and an equity risk premium of 5.5%. Meanwhile, the after-tax cost of debt is around 7.02%. However, the company's capital structure is heavily dominated by equity, with equity representing more than 96% of total capital. This result is relatively low contribution from debt in the overall WACC. Therefore, the calculated 11.07% of WACC will be used as the discount rate in the DCF valuation model. So using the projected free cash flow and the calculated WACC, I then estimate the company's intrinsic value using the discounted cash flow method. The valuation consists of two components. First, the first present value of free cash flow during the 5-year forecast period. Second, the terminal value, which represents the company value beyond the forecast horizon. After discounting all projected cash flow, the model produced an enterprise value of approximately 3.34 billion USD. After adjusting the for debt and cash, the equity value is estimated at approximately 3.88 billion USD. This result is in an intrinsic value is about 0.16 USD per share, or approximately about 2,704 per share rupiah. Compared with the current market price of 1,950, this implies a potential upside of around 38.68%. Therefore, based on the DCF model, PGAS appears to be undervalued in the market. To test the robustness of the valuation, I also conducted a sensitivity analysis varying the key assumptions of WACC and terminal growth rate. The results show that PEGAS remains undervalued in 24 out of 25 scenario tested. Even in the most conservative scenario, where the WACC is increased to 13.07% and the terminal growth rate reduced to 2%, the stock still show a slight positive upside around 1.3%. In the best case scenario with WACC of 11.07% and growth of 3%, the valuation indicates a 38.68% upside. This analysis suggests that the investment thesis remains relatively robust even under different assumptions. Although PEGAS operates in a near monopoly gas distribution market, it is still useful to compare the company with other energy firms listed on the Indonesia Stock Exchange. The closest sector proxies include Medco Energi, Energi Mega Persada, and Pertamina Geothermal Energy. Compared with these companies, PEGAS has the largest revenue scale, reflecting its dominant position in gas infrastructure. While its margins are lower, this is expected because midstream gas distribution generally has lower margin than upstream oil and gas production. However, PGAS trades at a lower EV to EBITDA multiple compared with the sector average, despite its stable infrastructure business and regulated revenue. This suggests that the market may be undervaluing the company relative to its strategic position. In addition to the DCF analysis, I also perform a relative valuation using common market multiples, including PE ratio, price to book ratio, and EV to EBITDA. Using the average multiples of comparable companies, the implied value of PEGAS range around 1,784 to 2,650 per share, depending on the valuation method. The EV to EBITDA method produces an estimated value of approximately 2,650, which is very close to the DCF valuation result. This consistency between DCF valuation and relative valuation strengthens the conclusion that the PEGAS may currently be trading below its intrinsic value. Based on the financial analysis and valuation results, several key conclusions can be drawn. First, Pegas demonstrates strong financial fundamentals with steady revenue growth and improving profitability over the past 5 years. Second, the company benefits from a dominant position in Indonesia gas infrastructure, supported by government regulation and strategic backing from the Pertamina Group. Third, the DCF valuation estimates an intrinsic value of approximately 2,704 per share, representing about 38.68% upside compared to the current market price. The sensitivity analysis also shows that the company remains undervalued under the most scenarios, providing a margin of safety for investors. Therefore, based on this analysis, the recommended investment decision is buy. In summary, Pegas represents a strategically important infrastructure company in Indonesia energy transition landscape. The company shows a consistent financial improvement, strong cash flow generation, and a dominant market position. Despite these strengths, the current market valuation appears to underestimate the company's intrinsic value. Therefore, based on the both DCF valuation and relative valuation methods, Pegas presents an attractive investment opportunity with a target price of approximately 2,704 rupiah per share. And yeah, so that is my presentation. Thank you so much for your attention. I look forward to any questions or feedback or any insights and comments. Thank you and see you.